All right. Good morning, everybody. Man, it feels like a Monday. So Netflix blew it out of the water if you only care about subscriber numbers. But if you look at everything else, they didn't do so hot. The street doesn't matter. It was all about the numbers. Today we got Tesla. Tonight, the numbers on that, every market has a widget, right? A thing that the market cares about. And sure, how much the company makes is pretty high up on that list. But usually it always revolves around a widget. For Netflix, it was subscriber numbers. How many new subscribers had they got? And that's why they had such a big blowout move. For Tesla, it's going to be car deliveries. Now, I missed the number. It was 2 something, but that was it 2 million? I don't know. It just started with a 2. But then what I heard on the show I was listening to was the street's estimate of that delivery number is going to be the hit or miss with Tesla. So, if they come in a little short on that delivery number, they're going to get walloped. So, sure, how much the company makes, and remember, Tesla's been cutting the price of their cars to sell more cars and to, poke Ford and GM and all the other legacy vehicles that wanted to go EV. They got a lot of different reasons for doing what they did. The main thing is, though, if they cut the cost of those cars, then they need to sell more cars to make up the difference. And that puts them in a pretty pickle because, well, I mean, there's still so many issues with EV, right? So we'll see. I don't think it's an easy run on Tesla for earnings. But if you're looking around today and you're thinking you might want to play Tesla earnings, try to find any information that talks about their car deliveries, because that's going to be what the big one is. We're looking at net market flow here. I'm going to just set this back to, really, we're on day 3, but we don't have the 3rd day yet. So let's just set it to 2 days. This is the market flow for this week so far, starting Monday into last night. Now, market flow is the combined premium for the entire stock market, everything that has options, as opposed to just looking, say, at NVIDIA or at Apple or something. So it's not just SPY, it's not just the Qs. This is all the options premium, all the calls and all the puts. So the calls are in green, the puts are in red, and the S&P SPY is in white. So if we look at this, the S&P really hasn't been doing much of anything, right? Just kind of ranging about between 482 and 486. We just really haven't gone anywhere. So a whole lot of nothing. The market continues to hammer out with these calls, though. So call premium continues to rise, and put premium, while it is staying around that 0 level, when I put it all by itself, it kind of shines a little bit better. Think about how we started the morning yesterday. The S&P was negative. It seemed like we're going to have a bad day. The puts were on the rise, and then we got back to 0. Now, by later in the day, they started to rally back up a little bit, but on the week, look at where we started and look at where we ended yesterday. We did a whole lot of nothing on the put premiums. Look at the call premiums, where we started the week and where we are now. So the market is still exuberantly bullish, right? And I was just reading from a couple of fund managers and top analysts. They're still looking at big tech. They're still buying it. They don't care, right? It's just get it, because that's what is getting. So you get what's getting got, right? Flows are there still, and the market just doesn't seem to care. So we play what we have, right? the best sectors, K-Web, that China, the whole China ADR talk that we had earlier in the week, staples, gold, and gold miners. And IBM just laid a bunch of people off. There was another firm too, but layoffs are still hitting. And SPY was up testing against that call wall. Good times. So this is what we got going on around the world. Hong Kong is still up 1.5%, more on that stimulus talk. Right now they're easing liquidity, which still runs directly towards stimmy. Then we've got small caps through the Russell, the NASDAQ at 0.75%, the S&P at 0.5%, and the Dow at 0.25%. It is noteworthy that Japan is at least in the positive, even if they're basically flat. And for the day, it's PMI. It's manufacturing is a big deal. So while this might not have the highest impact rate, I mean, yeah, I guess it does. I could have swore earlier when I came in, it was the yellow, but maybe I was just looking in the wrong spot. We do have some auctions today in the front end. And tomorrow we're going to get some data out of the ECB. So think about what you're holding and consider its impact as we get towards the later part of the week when some of this other data that the market has been waiting on starts to come in. It's going to start out of Europe, and then it's really going to hit us by Thursday into Friday. And we still have Yellen and QRA. There's still a lot left on the table. Yeah, here it talks about China lowering its reserve requirement ratio for banks. So they're easing liquidity. That's stimmy, however you want to look at it, at the end of the day. Although somebody made a good point yesterday, it's not exactly stimulus. It's just a rotation of capital. So if they're selling other things to buy China stocks, then they're just rotating, right? They're rotating out of something to get into something. It's not like the US, when just print money and throw it into the market. They're rotating out of something to get into something. $9:45, 10:30, 11:30, 1 o'clock. If you look at the S&P yesterday, the auctions kicked everything off on that rally back up in the S&P. It all started with the auctions. Watch the clock, right? I can't stress it enough. Watch the clock. Now the NASDAQ, that was a different story. It really flipped within the first few minutes after getting that textbook double bottom. But the S&P, it's I don't know, maybe a late bloomer. It got there eventually. So we got 49.38 on last week's range projected to the upside. That's still our target. We're not there yet, but we've got a good shot so far. It's worth noting how this weekly candle looks. There's no wick on the bottom. We didn't even try to come down and close that gap. We ran it right up against the high, right? We're still sitting up there so far. I mean, there's a tiny little wick up there, but nothing for nothing, right? Now, what I just measured here is the 3-day open range. We could just measure the 1 day, that would be the door. But there's a 1-day open range, the door, and then there's a 3-day open range, which is what I just measured. If we only use the door, then it's 49.22, basically. If we use all 3 days, that gets us back to 49.29. Neither one of those are at or above that weekly measure, so both of those could be used as minor targets. 49.29 and 49.21. So if you think about it, level by level, 21, 29, 39 on up, right? 53, just keep hitting it. Cumulative net volume is still negative. It's not moving with this. Now, granted, we're looking at the NASDAQ here. So if we were to go over, something like the NASDAQ cumulative or the NASDAQ composite, and then look at the cumulative volume, it might make a bit more of an equal perspective. That's what we have here. So IXIC is the NASDAQ composite index. We take this cumulative index, CVI, cumulative volume index, point it to the NASDAQ. And we had a significant divergence where the NASDAQ composite was going up, the net volume was still going down, and then everything started to turn back again. So we got volumes trying to pick back up, but we're just not there yet. We're working on it. It's at least pointed in the right direction. Volumes at 96, that's within our normal range. So they're trading as they normally would this morning. They're not hedging. They're not scared of the econ that's coming out. We finally did make it through that previous week high. So we'll just back up here for a minute. You can see the low of Monday and the low of Tuesday. They were hitting against last week's high. So when we talk about marking out pivot points, high, low, close on the weekly, the daily, the monthly, this is exactly why we talk about that. Even if you didn't want that for a trade, which I don't know why you wouldn't want it, that's a fantastic trade, you can use it for analysis. Now, if you go and mark every single line out everywhere, you would have so many lines you wouldn't even be able to read the candles, right? So it's not like I recommend marking every single line, but you definitely want to know where those levels are at when you do your top-down approach. So, yesterday morning, for an example, if you were doing your top-down in your notes, you would have mentioned something about we're still really close to the previous week's high. Any move to the downside should interact with that. This is the level I want to watch, blah, 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 right? You get your game plan for the day and lay it out so that you're ready to take some trades if the opportunity arises, or at least you'll understand why we flipped, right? And have a better idea about when you want to join this long. So we're still doing well with VWAP this morning. Nice continuation from yesterday. One of the things we want to do is measure out yesterday's range, just the RTH. And if we plot just the RTH, we can see that we've expanded well beyond the 50%, and 100% of the move gets us right up into our own ADR. We are through a voodoo line. Now we're going to use that as support. It's not the biggest voodoo line, but it is a big one, and we're on the other side of it. We opened above the daily pivot point, which, you know, the range is wider than the range from yesterday, but it's still a pretty narrow range, all things considered. It is an MDP because we haven't hit it yet. We're still holding above it, haven't touched it. It won't count today. It'll count tomorrow. Missed daily pivots are what we use after the end of the day, and we look at it, you know, tomorrow. We'll be looking back at today and seeing, was it still truly a missed daily pivot? It's still early in the day, although more than half of the trading day is already done. It's kind of a catch-22. But we're really close to the ADR half. And there is a logic that says if we hit that ADR too early in the day, we can actually turn around and go and hit the other side ADR by the end of the day. There's another logic that says if we can get past this ADR early enough, then we can get up to the full ADR. But to get there, we're going to have to get through this call wall. That's going to be a significant resistance. So 49.30. And remember that 49.31 is a COG line. So basically, that call wall is at the COG level. COG, center of gravity, COG. It's a significant resistance. I find it hard to believe we're going to get through there today without some catalyst or news to get us there. And I think it would have to be pretty good, right? So that's the line in the sand today, 49.30. I'm probably going to do some call credit spreads on that one. I'm still holding some put credit spreads from yesterday. I closed most of them out, but I was trying to roll and do something with them. They're going to expire today, and I just wasn't getting any good prices. I mean, we moved so fast yesterday that on my roll, I wasn't seeing anything good. I was better off just holding what I had. So what I might end up with is a risk-free legged in iron condor. So why not, right? I'll take it risk-free. It won't be a perfect risk-free because well, maybe. I had a 20-point spread and I got over 1,000 in credit. So yeah, it'll be a risk-free trade. Either way, 49.22 is the ADR half. If we can get past that 49.30 call wall and COG line, hard to see that we can get past that. On the other side, if we do start coming back, the first thing we want to do is get done with this VWAP. So we want to get on the other side of it, measure what we've done above it. We haven't got to the red line yet, so we don't have something to measure, but we'll just use what we have for an example. If this distance is our greatest distance from VWAP, take and measure that same distance on the other side. That'll be your first target for your downside break after we get through that VWAP. If we drive up and hit this line really fast and it's a bigger distance from VWAP than that right there, then use the new distance, whatever the distance happens to be. It's reciprocation. That'll just be your first breakthrough, right? Then they'll evaluate what they have there and decide if they're going to push us lower from that point or not. The 49.11 COG line is really close to this voodoo level. So if we do hit that ADR half and move to the downside, whichever's closer, this voodoo line or that measured move on the other side of VWAP, we'll use that as the first target to the downside. And from there, we'll just play it level by level. One of the things that I would recommend is marking out this entire zone from Monday's high to Tuesday's low. Actually, Monday had a better low, so I guess we'll take that. It's not better, it's just the lowest point and the highest point for the week. That didn't really give us much. Wasn't sure if it would or not. And a roundy, so not really insightful on that one either. Everything just lines up too good. So break the cog line, break VWAP, break the cog line, get to the roundy, get through that. And then we'll be at Monday's high at that point. But really Monday's high and Tuesday's high are equal. So it won't matter which one you use. I won't be surprised if we stay in this zone that we bring the point of control up by tomorrow. Otherwise, if we continue to expand outside of this zone, we're not going to build this volume profile out anymore at this level. And the point of control is going to stay down here because we've still got a lot of days of volume here. So something needs to happen, right? Either we start hanging out in one spot long enough to build a new volume profile, or we keep losing more of this congestion down here and we'll get into a ceiling. We'll hit a very large volume pocket somewhere and we'll bring a point of control up at that point. 4811 is the point of control as a cog line. But if we do fall back from here and rest within this zone, which absolutely could happen, then we're very likely going to start to build out that B shape profile. And we would expect it to bring up the point of control certainly by the end of the week, but more likely if we get back down there today, then by the end of the day, that could be our new volume location for the point of control. Rolling, we shouldn't have that just yet. The ES is on the March series and we're only in January. We have 51 days left. We'll roll before the end of those 51 days. So probably a good 35, 40 days, 2 market months. We have a new VPOC. So a move to the downside is going to want to take that into consideration. And we've got a discrepancy between the TPO and the volume profile this morning. So TPO is time, price, opportunity, TPO. It looks very similar to a volume profile, but it's not, it's different. One is volume by time, and one is volume by price. when we use them together, we can try to identify icebergs and ceilings and things like that. We hit a lot of volume up at this 49.15 level, and we're hanging out here long enough that we might actually bring this point of control up soon. If we'd have got here earlier, what we wanted to see was that we had a point of control up here and a real shallow area on the TPO. We didn't get here earlier. It's already built itself out. So now we don't know if it was a ceiling or not. But if we were to use, say, the Thinkorswim monkey bars, or what they call footprint charts on every other platform, I don't know why Thinkorswim had to be difficult, and come up with these monkey bar stuff. But either way, footprint charts, we'd be able to identify if there was a big order up here that we hit like a ceiling, and how many orders it took to get that filled. But we're too late. We didn't get here in time. We still want to see if it gets fleshed out deeper, and for a move back down, I'd watch that 49.08 area. We started to build it out there a little bit. It's the value area low. We still have a lot of bullish exuberance. So even if we do get weak today, we're still not looking at a sell-off. It would have to take some pretty big negative market news to give us that sell-off. We are near the edge of the weekly expected move, by the way. Now the S&P closes inside its weekly expected move 80% of the time. It's only supposed to do it 70% of the time, but the S&P's got a more accurate expected move than any other product in the marketplace. It's the most heavily traded, and not by a small margin, right? It's not like it's running neck to neck with something else. It's head and shoulders above 2 and sometimes 3 times as much options volume goes into the S&P than anything else. So, double Apple, double Microsoft, you know what I mean? Like, massive amounts of options volume. And these levels are derived by optionality. The more information that we have from the options market, the more accurate these levels are. So we're supposed to close inside the box only 70% of the time. The S&P does it on average 80% of the time. I don't know about you, but I don't like counting every single week and then trying to figure out how many weeks we closed inside and outside and if it was 80% or not. I cheat. I just use 8 weeks, 10 weeks total. You count back over the last 10 weeks and identify how many times it went into the close on a Friday outside of the box. If it's more than 2, then it starts to imply that things are off, right? That the markets are overshooting the expected move. It can happen for a number of reasons. Market makers get it wrong on the volatility that they've pumped into the market, or the market overshoots it due to something like econ, right? FOMC can pop us out, for an example. Non-farm payrolls, things like that. So they can try to price in the volatility measures, but when we overshoot it, that kind of goes against that check mark. A good rule of thumb is if the S&P is closing outside of this box more than, say 3 out of 10 weeks, that you don't want to use these levels with their probabilities in mind. You want to set those probability trades aside, iron condors, butterflies on the levels, things like that. They won't work as good if we're overshooting it. Now, back in the day, I would never have thought about it, but with the advancement of optionality and everything else, whether we're above or below the gamma level, right? We're in positive gamma, negative gamma, that has a large part to play as well. This indicator can't tie that in there, right? But we can go back to, looking at the charts, bringing in something like spot gamma's levels, and then laying that in there. We're in positive gamma. So we want to play the pins. We want to play targeted levels like weekly expected moves because they're going to work more in a positive gamma environment. If we were in negative gamma, we would expect to shoot past those levels. I mentioned the weekly pivot point earlier in the week. It's still relevant. It's even more relevant now. We're getting a little too extended from that weekly pivot point. I don't have a level in mind, like if it was the 10 week, I measure the 10 week and measure how far away from the 10 week we are. Here was the distance last week from the weekly expected move when we flipped. It wasn't too far. Here was the distance the week before that we were from the 10 week when we flipped. If you look at where we're at right now, and I know there's a lot of stuff on here, we're a considerable distance from that weekly pivot point. So, overbought, oversold, those are antiquated generic concepts, but we're getting a bit ahead of our skis here. And I would not be surprised if we pull back and correct just because of that. The weekly pivot point can't move. It's set in stone for the week. So we have to move. $3.65% above the 10 week right now. And sure, we've been higher than that before. We can look back and see that we've been higher than that, but not very often do we stay above that level for any significant period of time. Generally, we pop up through it and we fall back down through it again. Occasionally, we stick there for a week. This is something to really consider. We're at a turning point, and it doesn't mean that we have to get bearish. We don't have to go down. All we have to do is hold the line and let the 10 come up because it will move, right? We don't have to go down to it. We're only 1.5% above the 10-day moving average, and we've certainly been higher than that before and held that distance for a long period of time. So just getting to 1.5%, yeah, that's not overbought, not in the short term. It doesn't owe us a correction. We're not seeing a reason for mean reversion, least squared methods, dot plot statistics, linear regression. It's not showing here. Not just being 1.5% from the 10-day moving average, but in the bigger time frames, the weekly, yeah, we're getting a little bit out there. So it just implies we're likely due to pause. Now, I mentioned earlier in the week that we're probably done with the weekly, the yearly VWAP anchor. For now, anyways. I don't think we're going to get back down below that level. And now that we've broke out above this 48.50, I don't think we're going to get back down below that anytime soon either. But we're seeing more and more companies laying off workers. We're hearing through earnings that companies are struggling. They're having a hard time. It's only going to get worse. These cuts that are on the table that are being projected and being pulled forward, they were supposed to be normalization cuts. That, at least that's how Powell had laid it out last year. Now it's looking more and more like savior cuts. You know, they're going to come in and play save a hole and pick this market up. So we really need more as we get into FOMC. We need more out of the Fed, some clarity, some forward guidance. And we want to pay particular attention to what's coming out in the earnings on things like Tesla, but more, say, Microsoft, Google, Apple, right? The big dogs. If you have a chance, go back through the bank earnings and listen to their forward outlook. They usually do a really good job. The banks kick off earnings season, and they usually set the tone. All right, we're at the ADR half. That's my line in the sand for flipping things over today. I still think a call credit spread makes perfect sense. But I want to see this play out just a little bit more this morning. We got to get through 945, right? That's the PMI composite. And don't get me wrong, I mean, these auctions are on the front end, so they are worth paying attention to. We could see something in the later part of the day that exacerbates this move to the downside. I think we're just going to stall out here, chop about, maybe if we're lucky, keep outside of Monday and Tuesday's high, and that'll just be our zone. But there's two sides to this coin: base case argument and then alternate thesis. And, you know, like House said, you know, I'm always right eventually. If you cover both outcomes, then you're going to be right on one of them. Play the game with a theory that we're going to go to the full ADR. We stayed compressed for 2 days and built up a lot of energy. This could shoot all the way to the full ADR. Having said that, though, what we more likely will do is we'll reject at this ADR and we'll go down and get the other ADR. When we get to an ADR this early in the morning, a lot of times we just go and we hit the old one, the other one, the other side. So the base case argument is that we're going to go down there and hit the other side. The alternate thesis is that we're going to continue to the upside and get up to the full ADR. And you can see those levels on the side, 49.44 and 48.78. Now, we know that there's more than just those two scenarios, right? We could just stay right where we're at and just chop here for the rest of the day, kind of hovering around VWAP without really expanding too far in one direction or another. And I already explained how to measure this. So just take your greatest distance from VWAP and flip it over to the other side, and that'll be your VWAP range for the day. Like reciprocation, right? So we could just kind of narrow that up a little bit. We could just chop, but in this 25-point range, 49.25 down to 4,900 for the rest of the day, because it doesn't owe us anything. But that's not the base case argument. Come on, Thinkorswim. There it goes. The China ADRs are up the most. We can see that through KWeb, but also through MCHI. The FANGs are up right behind that, mostly with, the earnings kickoff. Netflix gave it a lot of this boost. We also have Bitcoin, more China through the emerging markets, gold, semiconductors, finance. This is a broad-based rally with basically everything. We've got jets, solar, energy, bonds. We got it all. This really looks like one of those rip your face off rally days. So let's kind of circle back to this for a moment. The base case argument is that we're going to go down and hit the other side because we got here so early. But I'm going to argue that today very much resembles what we had Friday. We had an MDP. We were considerably expanded from the weekly expected move, or from the weekly pivot. We were gapped outside of the previous day's range. We had a nice run up above VWAP. We reciprocated to the other side of VWAP. See that measured move that I just showed you? Same concept. So we reciprocated to the other side of VWAP, based, balanced, and then we had just this ripping, explosive move through the whole day. It's one of those rip your face off rally days. Yeah, I'm not the one that names those things. I'd come up with something that sounds, I don't know, better. Either way, there's trend day requirements, criteria, a checklist. Not for trend. Trend can be found anywhere, but for a specific unique thing called a trend day. Like an Oreo cookie is a specific kind of cookie, just not any cookie. Trend days have rules and criteria that must be met. One of those rules and conditions and criteria is that it's outside of the previous day's range. It's outside of its own Globex range. Those two has to be met. And then it's the morning version or the afternoon version. With every sector and every industry up this morning, we are primed for one of those kind of days. Yesterday, we had a stock pickers market. You had to be very selective of the choice that you made for what you were going to trade. On a morning like this, with everything up, just close your eyes and throw darts at the wall. You're going to hit the wall, right? Something is moving to the upside today. The trick is whether or not we're going to keep it. So, is this a blow off top before we dump? Or is this the start of a continuation play like we had last Friday? I would argue that even last Friday, we still reciprocated first to the other side of VWAP. Remember that measured move? So I would expect nothing less than that, which should get us right around this pivot point, that 49.02 area. Just from, a wink, wink, nod. That's about right. Watch really careful for a rug pull today, guys. If this is a blow off top, they'll yank that rug out from underneath the market and it'll all just come falling down like a domino tower. If they do that, things that are up the most, other than the KWeb constituents, is probably what I'm going to want to short. And we're talking day trade stuff, right? I'm not recommending anybody short the market on a bigger time frame than Friday's expiration kind of stuff. But with this broad of a rally, you got to kind of try to figure, where's the rug pull going to come from? PMI? I mean, it could. PMI could come out bad enough to be the rug pull that we're looking for. Watch the options flow too. You know, we kind of hit on that. I started with that. So if it's going to flip on us, we'll see red and green cross like it did back here. This is yesterday's, by the way. So we had a red green cross. That's a bullish or a long trigger. If they're going to pull the rug on us, we should see options on the put side premiums cross the call side premiums and get a downside move. And then we would lose all of the sectors that we got. Right now, it's too broad based to think that they can do that without some sort of news. I guess it would be easier just to ask what's not up. Cloud computing, which a lot of times cloud won't even get enough pre-market to move it, and it'll still be showing whatever happened yesterday. And then US dollar Japan is down significantly. That's a big piece of this puzzle. Yeah. The Dixie's breaking down below 103. Bonds are moving up, not as strong as stock, but bonds are up. The 10 years down significantly, and US dollar Japan is down. Breaking that 10-day. No rug pull here. If we bounce on that 10-day and manage to say, you know, get back above it like we did yesterday, then it's possible. But look at that move that we had in the dollar yesterday, and look how it didn't help. It didn't change the market at all yesterday. So, you know, that didn't have any bearing or any impact on the market whatsoever. I think if we're going to get a rug pull, it's going to come from something else. Maybe out of the 2-year. And we do have the front end auctions today. Trying to think about where the catalyst would come in. what you're going to see as we get into the open is a really high tick value. Let's back this up to Friday, so you kind of get an idea how we opened. Friday didn't open all that bullish. So this was Friday. We stayed mostly bullish. You can see how we stayed in the green way more than we were in the red. Especially in the later part of the day when we had that rally day. All right, so here's the SPX on Friday. Kind of consolidated. We have that half-day wedge breakout with a Busby and then a nice continuation. I love that half-day wedge breakout. So breakout, Busby, and then run. Look at how the weighted AD on that Friday was just holding below that 250 level, right? Then we really started to get above 250 and the slope just picked up nice, steep, fast. So we got above that 250 and we really expanded. The ticks led the way, gave us a plus 750, plus 1,000. That was like the trigger to really kick us off. I write about this all the time, right? When I do my midday review and I point out levels and I say, if we're going to get bullish, I need to see these things, and I lay out levels. These are the two things that I point to a lot. I point to the ticks and say we need like a plus 750, plus 1,000. And I point to the weighted AD and I lay out what we need to see with these. So this is what you're going to want to focus on today. We're going to open with these already bullish. If the market is going to get a rug pull, you're going to lose the ticks and you're going to lose the weighted AD. And very likely it'll be that cyan line that's buried in there. It'll start that move to the downside. You can see how it doesn't stay nested like it was on Friday. A lot of times it'll expand above or below and it'll lead the way. Now, Monday, I went over the IWM long call, laid out levels for us to target. This index is no different than the other indexes. If we're bullish in the market, we're bullish in IWM. It's not as bullish. We're barely back up to yesterday's high, while the S&P and the NASDAQ are well above yesterday's high. So sure, it's bullish because everything is bullish today, but it's not as bullish. And it's already took the rejection. The S&P at least got to the ADR half first before it got rejected. This didn't even make it outside of yesterday's range. Pivot points, open, high, low, close. This got to a pivot point and took a perfect rejection. It got overextended from its VWAP. Where's it going? Back to its VWAP. Get to that, measure this distance, plot it to the downside. You're looking at 197, and then you're into a gamma level. If you get below 196.80, then you're basically in negative gamma. Gex flip. We also, by the way, have already reached the measured move for the day in IWM. It's not my measured move, but it's a 1 standard deviation measured move from the optionality levels that I share. I share these levels every day with my watch list, right? This watch list has the FANGs in it, the XLs in it, gold, silver, the VIX. So I share these levels, these option levels, and they all line up with that watch list, so that if you're on TradingView or if you're on Thinkorswim, either one, you just go to that market. There's your options levels. I think what we have in IWM is going to be all that we get. If this broad market rally stalls, I think IWM will sell off first, considering how weak it is. So it's up from the close. It already reached its measured move. That's very likely all you're going to get unless this broad market rally continues, in which case this thing can lag behind as much as it is lagging on anything else. Look at the change percent for the morning. IWM is up 1.16. So the S&P now I've got the SPX instead of the SPY. Is up 0.5%, and the Qs is up 0.91. So small caps are up the most, and yet they're still not able to get outside of yesterday's range. They're already at their measured move. If you're wanting to day trade this, then you're going to want to trade the range. It's got to get out of that. Otherwise, this is what you're going to play, and you don't want to run a short shares on a trade like this. You want to play like an inverse IWM to go short IWM, right? You don't want to short the stock. This is now a double top. Double tops are bull traps. We would expect price to overshoot just to convince all the bulls that we're really breaking out so that they get in and then rug pull, squeeze them till their heads pop and make them puke their trade out. The overshoot level to be a bull trap would be the 111 warning center at 199. We would expect price to break out, get to that level, take a rejection, fall down, and then that's where we squeeze the bulls and make it a trap. If it's a true breakout and we're going to continue, we would expect to get through 199, get to 199.5, pull back for a Busby, and then continue to the upside. Just like back here. There's your double top, which ended up being just like more of a cup. We finally broke the level, pulled back like a Busby, and continued to the upside. Well, this is just a bigger version of the same thing. So is it going to be a cup and handle and a continuation? Or is it going to be a double top with a breakout that fails and then we reject? The question is going to be whether we break out and stall at that 199, or notice how we haven't broke out yet. Are we going to get here, get a handle, and then shoot straight through? How either one of those play out would be how your trade would play out. I think if we get a decent pullback to the 786, that would be your handle. You could even get a halfback pullback to 196.8 and then go, although that would be a deeper handle than I would expect to see. 618 would give you your third, and they say cup and handles usually do a third for the handle. So 618 would be about right there. That would be your long side drive on a pullback, which is what everybody wants, right? Otherwise, if we overshoot, I would want to see it get past that for a long. I'd want to see it get past that and pull back like a Busby, like we did back here, where we overshot and we pulled back and then continued. Everything's bullish this morning, guys. You could run your alpha protocols on a morning like this. Just watch for the rug pull. Every sector, every industry, everything's up. So you're going to want to watch for the rug pull. Watch the weighted AD and the ticks, like I was mentioning, and even just something generic and simple like the advancing versus the declining issues. These are going to open really bullish, really high up right from the get-go. You can see advanced decline even on like Yahoo Finance and Google Finance, places like that. If you don't have it in your broker, just Google it. You'll find a free version somewhere that you can look at. If you're on Thinkorswim, go to Market Watch, go to Visualize, set it to the index, choose your index. So there's the S&P. This is an advanced decline with money in it. There's the NASDAQ. And there's the NYSE. Those are the ones I usually share in chat and keep my eye on through the day. You can do them all. In fact, you can do your own watch list if you want. I've done it with the FANGs, no less. You can just make a watch list and tell it to look at that. But you've got the capital flow, you got the advancing issues minus the declining issues. So it's not just advance versus decline, but also money. You can see divergence, which happens a lot more than we would expect. Keep your eye on that broad market today, because if they pull the rug, it's going to have to be, well, you know what? Let me rephrase this for a second. If they pull the rug, it might just be in the indexes. We seen the other day where the S&P was kind of laggy. Well, Monday and Tuesday, we dragged our feet most of the day. But if you looked at the broader market, we had a ton of things that were really expanding and doing really good. So stocks were doing great. The indexes were sideways. Now we finally got the indexes on the move. The S&P and the NASDAQ are expanding strongly. Every single sector and industry out there is ripping. The rug pull is going to have to come in here. We got the dollar down after a big run yesterday, and that didn't seem to bother anything. 10 years, same thing. US dollar Japan, same thing. And it didn't touch the market at all. Everybody be careful, be safe, have a good day. I will see you all tomorrow.